Hey everyone, welcome back to Drawbridge Finance. My name is Levi Woods, and today I want to talk to you guys about portfolio diversification and why it's super important. Now, for those of you who have been following my channel for a while, you know that I am mainly a dividend investor, but I also do a lot of option trading. And option trading is a little bit difficult to follow. So this particular video, I'm going to set it up as if I had purchased the shares. But so you know, I didn't actually purchase these shares. I made this position as an options trade, and I'm having to manage it now. So essentially, it was a bad decision on my part. Back in August 14th, 2017, I decided that Rubbermaid, Newell, so NWL is the ticker, it was a good position for me to enter into my portfolio. And I decided that the price point, $50.10 at the time on August 14th, was a fairly low price, and that I expected that the stock was going to rally and go up. And it hasn't. It hasn't at all. It's actually traded on Friday at $30.77, which means I'm down like almost 40% on that particular trade. So what I'm going to show you guys today is why that doesn't really damage my overall portfolio, being down 40% on a single trade, because I have diversified enough that it's a small percentage of my account. I'm not going to run through the real numbers. Obviously, like I said, it was an option trade. But what I'm going to do is I'm going to set it up with our four fictitious characters that I like to use. So we've got Alice, Bob, Charlie, and Doug. I'm going to run through the scenario of them purchasing that same trade, August 14th, for $50.10 and investing in a different percentage amount of their account. So what I've done is I've arbitrarily just picked the top 10 stocks that I currently hold in one of my trading accounts. I was trying to make it fair. I was like, how do I do this scenario so that I can pick stocks that have moved or haven't moved a lot in the same time frame? And I thought the best thing to do would just literally be to take the top 10 stocks in my portfolio and alphabetically, and those are the ones I picked for Alice. All right, well, let's take a look at the four characters that we have. So as always, we've got Alice, Bob, Charlie, and Doug. And the setup for this particular scenario is that they each had $30,000 and they were going to open an investment account in August of 2017. For purposes of demonstration, I'm going to show you how that money gets distributed. And so if we look at this, each of the characters has a total of $30,000. As close as possible, Alice has decided to divide her account into 10 different equities. So she's picked these 10, and again, I just picked the top 9 that I had in my portfolio that I currently hold, as well as the Rubbermaid, which was the one that really tanked, just to show you guys what happened. The number of shares that we decided to purchase for this scenario is determined by the amount that she wanted to invest. She wanted it to be equally divided by 10%, so we bought the number of shares that correlated to the price per share so that it would be as close as possible to $3,000. So you can see that there's around $3,000 in each of these transactions, and she's left with $31 in cash at the end. That gives her $30,000, and we can look percentage of account, 10% in each. So Bob has a slightly different setup. He's going to diversify a little bit less. He decided he was going to put $5,000 into each one, but the same shares off the top. Amazon is not a dividend play, but most of these are dividend payers. So you're trying to reap the reward of having the dividend payout each month. So he's got $61 in cash, but he's got around $5,000 in each of 6 different stocks compared to Alice's 10. Now Charlie has decided to just invest in 2 different stocks. So he's invested $15,000 in each of Apollo, which is a dividend play, and Newell Rubbermaid, which is, he thinks at that time, is a growth play. So he's buying at $50 and has a total of $14,979. He's got $22 in cash. Doug, he is fully in on Rubbermaid. He thinks it's going to be amazing. So $50, he buys way more shares than everybody else. He puts his whole $30,000 into Rubbermaid. So 99% of his in one particular company. Let's skip forward to today. Let's look at the dividends collected during that time. Apollo paid a dividend once. AltaGas pays their dividend monthly, so there's actually 3 payments of dividends, totaling $74. And you can see that Bob collected more in dividends from AltaGas because he had more shares. He had 179 shares and Alice only had 107. So the dividends that Bob collected are actually a little bit more because of the 6 companies that he had, only one of them didn't pay a dividend in that time. Alice actually has 2 growth plays, Berkshire Hathaway and Amazon, and neither of them pay a dividend, so her dividends collected were a little bit less. But she's hoping for growth on both Amazon and Berkshire Hathaway. So now let's look at November 3rd and see what's happened over that time, because none of these characters have really looked at their account. They basically made this purchase in August, and now the dividends have been growing and they've been ignoring it. And if we look at the price per share, a lot of these stocks, as we would expect, haven't moved very much. We paid $6.32 and it's currently at $6.09, and AltaGas was at $28 and it's now at $29.50. So these are relatively small moves, which means that percentage-wise of the account hasn't actually changed very much. 10% is 10.3%. Amazon actually went up quite a lot from $983 to $11.11, and so that percentage of account went up, 1% gain here in the total. But this Rubbermaid, you can see that this stock price plummeted from $50.10 to $30.77. Very small dividend paid by each person collected a little bit of dividend from Rubbermaid. Obviously a bigger dividend based on the number of shares that each one held. So this cash is derived from the total cash that was in before plus the dividend that's been paid out. That's where we were getting the cash total. So here's Bob's $61.50 plus $471 gives you $533. You can see that Alice is the winner here in 2 ways. Both of her growth stocks went up. Amazon and Berkshire Hathaway saw an increase, and then she collected some dividends. So her portfolio value has gone from $30,000 to $30,594. So she's plus $594 in this 3-month period. Bob is also in a very, very good spot. His value has only dropped around $50 because he's been collecting these nice little dividends, and if he sold today he would be down $50. And you have to remember that this is part of his portfolio went from $50 a share to $30 a share. That's a massive loss if he was to sell that. So those dividends have really helped bump up the total portfolio value. Charlie was not diversified enough. Because he had 50% in Rubbermaid, his value, his $14,979, has dropped down to being worth only $9,200 today. Now, of course, the loss is only realized if you actually sell today. If you don't sell, then you actually haven't lost any money. You're going to continue to collect the dividend, and this stock price will hopefully go back up. I'm hopeful because I'm actually still in this position, and I feel that Rubbermaid is a good company, so I'm not worried. I'm not going to dump this position. I'm just going to be patient and let the value of the stock return because I'm pretty confident that it will. But you can see that Charlie's $30,000 has dropped down to $24,000. He's lost almost $6,000 in value of the current portfolio. Again, he only has that loss if he sells. But currently, if he sold today, it would only be worth $24,000. Doug, on the other hand, has lost a ton because he put his whole amount, the $30,000, has dropped a huge amount. So he's down to $18,578. He's lost, 40% of his portfolio value, and it's a terrible situation to be in. Of course, he hasn't made this loss. It's theoretical until he sells. So as long as he holds his position, it will hopefully go back up. But he's probably not feeling very good about his investment strategy. I'm going to show you guys what would happen if the stock had gone up. Because say it had gone to $60, if we just make that little change, she would have had a $2,300 gain on it. From her $30,000 would have gone to $32,000. Likewise, Bob would have had a $2,800 gain as well. Charlie would have made a $2,800 gain, and Doug would have made a $6,000 gain. So he would have been a clear winner. But this is an example of how this could go either way. I mean, in reality, it didn't. So by putting all of his eggs in one basket, Doug was hoping that he would make a huge amount of money and beat out everybody else. But the reality was he couldn't see into the future, and he was unable to predict the movement of the stock. And because of that, the stock actually closed down at $30.77, and he was theoretically down money. So this is why it's super important to diversify. We can see the direct correlation between this $30,000 and the dividends collected, $429, very, very close to the actual realized profit. If she pulled out the investments now, Alice would have made $594. So a good chunk of that is from the dividends. And Bob, these dividends helped sustain the fact that he lost a bunch of value from this $5,000 investment dropping down to $3,000. So this is why diversification is so important. Thanks so much for watching. If you guys like these videos, please give me a thumbs up below, give me a like, send me a comment, send me your questions. Let's get rich together.